Hi, this is Mike Larson from Money and Markets TV. There's no longer any doubt that the global economy is fading fast, and many markets around the world are rolling over sharply. Consider the most recent evidence. Indian industrial production plunged 5.1% in October. That was more than 4 times the drop that economists expected, and the first decline since June of 2009. As a result, the Indian rupee tumbled to its worst level against the dollar ever. Meanwhile, Brazil's economic growth is slowing substantially from last year's rate of more than 7%. In fact, the economy stalled completely in the latest quarter. As a result, Brazilian stocks are falling along with its currency, the real, and China's export growth just slumped to its lowest level in 3 years. That followed weak news on manufacturing and auto demand, and in response, China's benchmark Shanghai Composite just hit its lowest level in 33 months. Now, you already know Europe's a basket case, so there's no need to rehash its problems. But even here in the US, the so-called economic recovery is starting to peter out. The latest data showed that retail sales rose just 0.2% in November, the weakest reading since June. In addition, the housing market's showing signs of cracking again, and corporate profits are likely to be weak this quarter. We've already gotten earnings warnings from Best Buy, DuPont, Intel, Texas Instruments, and others. But despite all this bad news, stock market bulls have still been holding out hope for a Santa Claus rally. Unfortunately, policymakers in the US and Europe seem intent on dashing those hopes. First, the European Central Bank ruled out money printing to buy the sovereign debt of struggling nations. Then came the grand bargain signed by most members of the European Union. They submitted to tougher fiscal discipline, agreed to funnel 200 billion euros to the International Monetary Fund, and moved up the date that the Eurozone Rescue Fund will be put into place. That deal is a desperate attempt to stave off a debt market meltdown. But the problem is that these are all just rehashed ideas that have previously failed to stem the debt crisis, and they do nothing to lower the borrowing costs of the nations that are supposed to pay for them. But the final nail in the coffin of the Santa Claus rally came on Tuesday with the Federal Reserve's decision on monetary policy. Penn Bernanke and company gave no hint that a third round of quantitative easing was coming. In other words, the policymakers that the bulls have been able to count on for so long are out of bailout solutions. Nothing is working for more than a few days because the underlying problem has not been solved. Too many countries and too many banks owe too much money, and defaults and deleveraging are inevitable. In these troubled times, smart investors have to use protective strategies. That means taking profits on long positions, adding inverse ETFs that rise in value as select assets fall, and for your more speculative capital, consider trades with more leverage and therefore greater profit potential. I'm Mike Larson from Money and Markets TV. Thanks for watching.